Chinmay, please come on the dais.
Good afternoon, everyone. It's not easy to introduce all these stalwarts. I'll just take a try. So I'll start with CA Chetan, sir. He comes with a 30 years experience and deep understanding of the company's mergers and acquisitions, private equity and IBC transaction processes. And his expertise includes transaction support by performing FDDs, buy side and vendor side, inbound and outbound transactions. And he's an ex-PwC, ex-GT partner, and he presently heads the due diligence and transaction services practice of RBSA Advisors. So, welcome, Chetan, sir. So, Ketan Dalal, sir, he's a managing director at Catalyst Advisors Private Limited. He's a veteran with 40 years of experience in structuring and tax, including mergers and acquisitions. He was a joint head of tax all over India and the managing partner West and a member of the India leadership team with PwC India. And after that, he runs his boutique structuring and tax firm Catalyst Advisors. He's primarily into structuring and has been involved in various transactions with Shapoorji Pallonji Group, TVS Group, and other industry leaders around India. And he was a member of several SEBI committees, including SEBI's high-powered advisory committee. He has directorships with HDFC Life Insurance, Zensa Technologies, a part of India's finance ministries, working groups on non-resident taxation, and multiple others accolades to his name. And among other books and articles, he has authored a book on Indian taxation decoded, an MNC perspective in 2018 as well. Welcome, Ketan, sir. Now I'd like to introduce C. Amirsh Shah, sir. He's a part of the executive at tax practice of Deloitte in India, specializing in M&A tax. He has more than 31 years of post-qualification experience and has worked with boutique Indian tax firms and Big Four firms. He has advised large multinational and Indian companies on acquisition, divestment tax, regulatory structuring to optimize tax incidents, as well as direct tax due diligence assignments. And he has also been a part of the CII Tax Committee in 2014. He regularly contributes thoughts on air and print media. He has involvement across various industries, including domestic and cross-border merger transactions. Some of them include direct tax due diligence, advisory services for merger, divestment advisory services to private equities, and other Indian and global companies. Welcome, Amirsh, sir. And I would also like to welcome our moderator, CA Chinmay sir. He's a partner transaction advisory at KC Mehta and Company LLP Chartered Accountants. He's a CA and holds certificate on Master in Business Finance by the ICAI. And he has 14 years of experience in the transaction advisory and assurance services and has been working with Indian as well as global consulting firms. His role includes FDD, vendor assistance for M&As and IPO, business plan and feasibility reviews, transaction structuring, corporate financial structuring, and the like. His experience span across industrials, specialty chemicals, pharma, FMCG, and multiple industries. And apart from CA, he's an avid cricket follower, and he spends time reading business journals and takes keen interest in value investing, along with being a speaker and guest lecturer at various forums. Welcome, CH Chinmay sir. Yeah, I would like to invite sir to give a memento to all our faculties, CA Chetan sir, Ketan sir, and Amirsh sir, and Chinmay.
Doesn't matter, we'll exchange it. If it is a different, there's no name.
Yeah, Amirsh sir. Yeah.
Huh?
Chinmay sir.
ले भाई.
Thanks a lot, sir. I would like to request Chinmay sir to take it forward. Thank you so much.
Hello. Yeah. Thanks, Tanay, for the wonderful introduction. It's an absolute honor and privilege to host this session among the stalwarts and the best in the profession. It would be an honor for me to question them from whom I have learned and from whom I have heard of M&A structuring, transactions, and taxation all throughout. So, as much as you guys are looking forward to, even I am looking forward to this session. Maybe to start with, I think in terms of the background, I think a lot has been said, discussed, spoken about due diligence. We also had one session just an hour ago in terms of the legal due diligence and aspects. So there is no doubt why due diligence is absolutely important, highly critical for any transaction. The idea that we want to convey by way of this session is to take you to the practical aspects about what really happens in terms of a transaction, in terms of due diligence, how does it impact the deal structure, financial aspects, commercial aspects, and the taxation aspects of the deal. So maybe with these words, I'll hand over to Ketan sir to start with. Maybe we'll first have a quick round of introduction in terms of what their thoughts are around due diligence as a subject and how does it impact our transaction, including its structure. So maybe we'll start with Ketan sir, then go on to Chetan sir, and then Amirsh sir will first give their views around the session and the topic for the day, and then we'll have certain specific questions, and then of course the floor will be open thereafter for Q&A. Sure, sir.
So thank you, Chinmay. First of all, this Ketan and Chetan is causing confusion, so sorry for having picked up your memento. No, I think in terms of due diligence, etc., first I think it's important to step back and look at the bigger picture. And the bigger picture is that of M&A activity itself. And before this, Amirsh and I were just chatting. First, there are 2-3 aspects that we need to bear in mind in the evolving M&A scenario in India. The first scenario, the first situation is a sort of more social and softer issue, and that is that the stigma of selling a business, to my mind, has largely gone. Of course, valuations have helped. When something which you thought was worth 200 crores, you're getting 1,000 crores, all sorts of stigmas can vanish. So that's one, but genuinely also I think the stigma has gone. I think younger generation has come, they're saying, okay, I may exit this business and I'll get into another business. So I don't think there's anything wrong. That kind of attitude and approach. The second issue is the heart of what we are going to discuss, which is the commercial imperative. So due diligence follows a commercial imperative, but the commercial imperative to sell or buy a business. For the seller it is sell, for the buyer it is buy. And let's look at it more from the buyer's perspective. Now let's say aviation, so the Air India Vistara. Let's say packaged food, Tata Consumer buying Capital Foods, Bain is looking at Haldiram. Let's look at logistics, JSW Infra doing a sort of backward integration into the acquisition of Naukar. Competitors getting together, PVR Inox, the Viacom Disney deal. I think all of these are being driven by significant commercial imperatives. Cement, the amount of action in cement with the Adani, with Ultratech is enormous. And I think the commercial imperatives cannot be the same for each sector. So for example, in cement it is scale, Ultratech is 150 million tons, and with ACC and Ambuja and a couple of acquisitions, Adani is already at 80 million tons. Now that kind of firepower cannot be easily replicated, and there is that race for consolidation, including geographical expansion, because none of them has, let's say, presence in the south. So it could be scale, it could be geographical issues, it could be distribution network, it could just be general size, market share, pricing power. For PVR and Inox, the ability to combine together will enable them to sell popcorn at 400 rupees, where the cost may be 10. If you don't get together, you will drive down the price. Of course, I'm not saying 400 is the right price, it's not, but I'm just trying to say that this kind of commercial imperatives, and the reason that this goes into our topic is because when a commercial due diligence is done, as opposed to a financial or a tax, these are the kind of issues that will obviously be looked at. And of course, Mehul spoke about legal due diligence in the preceding session, which I'm aware of. So all this will somewhere overlap, but I just thought that I would give at least my thoughts on the commercial imperatives, and these were some of those thoughts. So with that.
Sure, sir. Thank you.
Thank you. But I know it was a privilege for me to take moment in your name. Just to add on to where Ketan is coming from, definitely commercial is the key thing for any deal, whether it's a private equity transaction or a M&A transaction. But when it comes to hardcore diligence, you actually open the books of account. આપણે ગુજરાતીમાં કે ચોપડા ખોલીને આપો kind of a step. When you actually deep dive, then you will really come to know what was the thought process, what was the understanding which was there, whether it is really percolating down the line. It's actually reflected in their numbers when you meet up the customers, meet up the suppliers, or if you don't meet up also, at least read their contracts, do those understanding, whether it's really makes sense or not, and then the deal definitely would be going ahead. But it's an informed decision which at the end of the day you take. All this glamour of M&A, private equity, it looks good, but a lot of hard work goes into that, and the decision is sometimes taken by emotions and most of the times not taken by emotions. It's anybody's guess kind of a stuff. So I always give an example. It's like, if a bride and a groom, they are looking out for each other, the parents, the relatives will do their own diligence, and they will evaluate each and every options. And of course, you are not going to get all the pluses, you are not going to get all the minuses, and there will be a trade-off between plus and minus, and then they will take an informed decision. So diligence is something like that. Means you do commercial diligence, legal, financial, tax, IT, and number of kind of stuff, and then you take an informed decision, and then you just leave it to Almighty or whatever you call for the results kind of stuff. Thank you.
Thank you, sir.
Thank you, ICI, for having me here. I think due diligence is very closely related to M&A, is how I put it. And my M&A here has two different words, to the M and the A. If you do it right, you will be in the marriage. If you don't do it right, you will be in the alimony. So I think one needs to be very careful, when you look at due diligences, right? And I think that's the key. And that's why if you see every M&A transaction, there will be some extent of due diligence which will always happen. Now, whether you do it, at a very broad level, or you deep dive and do it, at a level which you want to be satisfied as either the acquirer, or somebody who's going to put money along with the acquirer. And we've seen different types of diligences. So if, a seller is wanting to invite a lot of people, then, they will want to do what is called a vendor due diligence, right? And that's done with the perspective to provide all the facts, and maybe from a tax perspective, some history around litigation issues and all of that. But if you do it from an acquirer's perspective, the level of evaluation that one does is even much more deeper, because you need to put in the money. And when it comes to tax in particular, I think there are 3 or 4 elements that we will want to first understand in deep. Obviously, you'll go through the tax returns, you'll go through the computations, you'll go through the compliances. That's the base that we will look at. But what's the historical litigation that the company is carrying? Who are the company's advisors, right? Because that gives you a perspective as to how the company is looking at, dealing with its tax issues. Today's world, some companies provide tax transparency reports. So one needs to go through that, because it is a changing world, and this is a new concept that has come in. And those provide you insights into how the tax aspects have been dealt with by the company. So the different elements, from a tax perspective comes in. Critical issue is, what we do is, if there is any past litigation, we will want to then deep dive into see whether it is a one-time affair or whether it is going to be a continuous thing that is going to happen. Because, you will then want to see how to say, because diligence is always like audit of the past. But, an acquisition is made with a forward perspective. So you need to therefore be able to cover both sides of it. Looking at the past, what's likely to happen in the future. And I think that's where, the entire diligence element comes into piece. It's not, basically just an audit or a scrutiny, it's more an evaluation. And I think if we do it from that perspective, I think we'll fall into the M category for our clients rather than the A category that I mentioned.
Thank you, thanks a lot. Thank you, everyone. So I think one theme is clear, from the two of our speakers, that there is a parallel being drawn with a marriage. The only thing is that this marriage cannot be reversed so easily. And that's basically the reason why, you need to be extra careful at the time of making the deal. And looking, of course, at the commercial and the aspects which are going to impact a transaction years down the line when you're actually signing off a transaction. So maybe with this, I'll go on to the specific questions. I'll start with CA Ketan Dalal. Sir, since I think a lot of air comes when we talk about due diligence, how does it impact valuation? Does it really turn out to be a deal breaker or deal maker, etc.? So how would you want to draw a parallel that, how does a due diligence exercise impact the valuation, and what would be the typical risk that you see, and how do you end up mitigating those risks?
Yeah, so you see, the point is that let's just step back and see how the process would normally work. And just for sake of simplicity, I'm assuming that it's an unlisted company for the moment. So let's say the buyer and the seller would have discussed through merchant bankers or otherwise, and they come to a in principle agreement. And most of the agreements before that, when I say agreement, I'm not talking of legal agreement, but it could be in the form of capturing it in a term sheet. And say, okay, here is the agreement, here is the term sheet, and we go ahead with the due diligence. That's one possibility. The second is to say, okay, I do an agreement, but subject to that condition precedent, but usually that would be unusual. So in that due diligence, one of the biggest issues is what is the scope of the due diligence, and obviously the buyer would want to expand the scope of the due diligence and the seller would want to restrict the scope of the due diligence for a variety of reasons. And it may not be, the reason may not be to hide something, but the reason may also be confidentiality, because the more the breadth and scale of the due diligence, the more the number of people, the more the possibility of information leaking, and if the deal doesn't go through, then it has adverse consequences on the business of the seller in all probability. So on Chinmay's point and question regarding impact on the valuation, so what may happen is, one possibility is that let's say the liabilities turn out to be so much more significant than was originally estimated that it becomes a no deal scenario. That's an extreme possibility, but it can happen. Of course, it's not just a question of liability, because we spoke about commercial due diligence. So in one case, the acquirer is getting worried about customer transition because it's a services business, warehousing business. It's worried about customer transition because the customers have to agree. It's a very sensitive kind of product that is being stored there. So, and the seller is not willing to guarantee the transition. He says, I can help, you can hold back 20% of the amount, but I am not willing to guarantee 80%. I just want as an upfront kind of thing once we sign the SPA. Now, these are the kind of issues that can arise. So it depends in different ways, it will impact differently. So on the valuation part, I gave the example of liability. Amirsh spoke about tax litigation. So what may happen is that there may be something which which is a potentially heavy tax item, and the buyer may say, look, I don't want to get into this unless I give a haircut off or reduce the price by say 30%, and the seller will say, what are you talking? This is a absurd litigation, which probably it could be. Those are the kind of issues that can, in one case, not on tax, but on an insurance situation, there was a claim. Honestly, I didn't understand it very well, but to me it sounded like an absurd claim by a client 20 years ago or 15 years ago on a matter where he told the insurance broking company that you did not explain to me the risks. I took this insurance, there was an exclusion clause, and I didn't get the claim. So there was on an insurance broking company a potential claim of 1,000 crores, and the company itself was much smaller, like a top line of 300-400 crores. It sounds like an absurd claim, but we had a hell of a problem finishing that deal because the buyer kept on, and buyer was aware from the market about this, but kept on insisting that no, it can arise, and all our lawyers said, look, it is a less than 1%, 0.1% chance. But it took several rounds of negotiation, and although I don't know how much is the percentage of haircut we took, we definitely took some haircut on such an absurd litigation. So, to your point, Chinmay, of how it can value, this is an extreme example. But it could be many other examples. So one of the examples could be retention of people. That I say that, look, these are the 5 key people, and when I am talking to them in the course of a due diligence, I'm not sure I can retain this team fully, even with incentives. So I'm building in the risk of some of the key people living into my price. So I want to renegotiate that price, So it is this kind of a construct and ecosystem is what I would say, Chinmay.
Absolutely. So I think it's equally important to have advisors, to negotiate on behalf of our clients, the companies whom we are representing, right? So first of all, to identify what are those risks which are mitigable, which are not mitigable, those risks which could actually lead to an adjustment. Plus there are certain other mitigation points. Yes, sir, sorry.
Yeah, so just to add, I think from a valuation perspective, if you were to just maybe restrict to the tax, right? Let's say if you're in an auction scenario, there could be somebody who can, take advantage of the tax attributes, that the target company has. Somebody may not be able to take advantage of that tax attribute. So obviously, you'll make those valuation adjustments, because ultimately the buyer has to justify, the ROI on the, price that he is going to pay. So I think it's very, very, very dynamic in that sense. Every situation will have, a different color to it. And I think we just need to be alive, through those situations. I've had one situation 10 years back after the 2012 Vodafone amendment, right, where somebody had done multiple transfers at the overseas level. Now the value of the entire acquisition was lower than a tax consequence if it would have arisen. So, the client suddenly started feeling jittery about doing the transaction itself. So there could be different type of elements that will come into play. And I think we just need to be very clear as to what will be the key that, we are looking at. And there I think, the commercial part that Ketan talk is on the business, but we also as tax advisors or, as financial due diligence advisors need to have that commercial bent to capture that. So we had one situation where we had a holding company and then we had an operating company. And, we kept on pushing that we needed a discount because when I sell from the holding company the shares of the operating company tomorrow, right, and the other person wanted to sell the holding company, the non-resident. And there were 2 non-resident, seller and buyer. They wanted to sell the holding company with a full value. But we kept on saying that, we need a discount because we can only sell the operating company. We don't know whether we'll be able to sell the holding company or not. And therefore there could be double layer of tax. Because first the capital gains will come and then, and that too at a higher rate because Indian's resident company will be at a higher rate, and then the dividend or whatever we do, buyback or whatever. And therefore we were able to get some discount as a result of that. So it's not only in the target operating that we need to see, we need to see the structure that we are acquiring. And think about a future issue that might come up. It's not a past issue because it's not a diligence issue in a way, but it is a diligence issue. So I think that's how the value adjustments happen.
Certainly. So maybe my next question would be to Chetan sir. So sir, if you can guide us with certain key deal considerations that you generally come across in a financial due diligence transaction in terms of the financial analysis or the valuation considerations that one has to look at into the deal from a buy side as well as from a sell side.
Okay, thank you. So just to, just further add on to what Ketan and Amirsh mentioned, As a process, what happens, you sign a term sheet or you sign a memorandum of understanding, and it basically says subject to various diligences kind of stuff. And of course, there will be a valuation adjustment after that. So normally in a typical financial diligence or financial and tax diligence, we come out with 3 important valuation adjustments. So first is the quality of earnings, then the working capital adjustment, and then the debt-like adjustment. I would say quality of earnings, debt-like, and then working capital adjustment. It has to put that in order. And normally, typically, you know that there will be either some deal will be based on EBITDA multiples, or you would do a DCF and come out with some value. But ultimately, you will come out with an enterprise value. So all these adjustments, if you just go step by step, the quality of earnings are nothing but normally it's EBITDA based. So normally you will come out with an EBITDA adjustment. It will be X minus whatever adjustment we are saying. Sometimes there will be a lot of non-quantifiable adjustments. Sometimes there will be quantifiable adjustments. And then those will become your enterprise value if you just multiply by that thing. And then you will do a debt adjustment and debt-like adjustment. And debt-like adjustment also can be endless. And practically I would say everybody is right in that. I would say this is not a debt-like, Ketan will say it's a debt-like, Amirsh will say something else. So it's very tricky, all debt-like adjustment. And sometimes you also have to look from a buyer's perspective or seller. So buyer will have its own view and the seller will have its own view kind of. And that will also have an impact on your working capital. So that's how, how the diligence helps in coming out with those valuation adjustment. And when you say debt-like and all those things, definitely tax also plays an important role, because if there is a huge tax litigation liability, you need to adjust that. Now coming to the deal considerations, we need to just understand first of all that we are doing diligence because we have been appointed by either by a buyer or a seller kind of a stuff. So we need to understand what are their pain points if you look from a buyer's perspective, because look, in a way he has already done his diligence, because of that you have entered into a term sheet. So it's not like he has just entered into a term sheet without doing anything. So we need to understand, are you aware about some pain points, or are you aware about any issues which we should factor in our scope of work? In one case, I was told that you put in the scope of work some forensic scope in the thing, and we'll be sharing that with the seller also. So I told him that it's very apparent that you are doing forensic. Any smart guy will understand. And diligence and forensic normally should not go together, because you are doubting the basic integrity, then why you are doing a deal? Somebody is going to question that. So we'll put that scope of work as a part of FDD smartly in various formats. So at least the seller will not come to know. But we'll have our forensic guy also come in and look at that particular area where you are interested kind of. But let's not put it separately. And he basically accepted what you are saying is correct. So that is the first step you need to understand when you have the scope ready. And diligence, always we want to ensure that whatever the financial information which we get it from the balance sheet and other things, we do a deep dive and go further into it. So our starting point normally, if you say, it will be audited financials. With due respect to the audited financials, it's not like we are doing diligence on the audited numbers, but we actually go beyond the numbers, try to do a deep dive on their MIS, on their sales, on their cost, related party transactions, their contracts, supplier contracts. And once we do all those analysis, we come out with our observations or the key issues, whatever you call it. And those observations, as Amirsh mentioned, that it's basically we are talking about past. But are these going to have a go-forward impact? That plays an important role. Something on the past is important, because if I come out with an adjustment to their gross margin, which we feel that it should not be, say, 20%, but after adjustment it comes to around 15%. Then definitely it's an input for the valuation, because either you will tweak the model at some point of time, or you will directly adjust your valuation. So and sometimes we come out with some adjustment which will not have any valuation impact, or the buyer seller will say, I cannot adjust it kind of a stuff. Then what should we do? Then you at least bring out in a right way in your transaction document to put it in the right perspective. Either you take adequate reps, warranties, indemnities. Sometimes you come out with earn-out mechanism. So if you feel that, for example, there are huge debtors of 100 crores which are sitting in the balance sheet and it's 1 year old. So what to do with that thing? If I do a valuation adjustment, nobody is going to accept that, because it's a straight hit. then you will have some kind of an earn-out mechanism. Okay, if you are able to recover this amount, then slowly we will try to work out a way. Or sometimes we say that there is huge dependence on the key promoters, so what should we do? And promoters say, I will also want an upside because there are huge contracts which are sitting because of me. Now the benefit is going to come to you in the future. Then all those things will be highlighted in the diligence report. And of course, based on the issues, based on the identification, you will come out with those adjustments. So this is broadly when you talk about considerations. I think I can go endless kind of a thing, but I will just restrict myself for this thing. If I come across something else, I will let you know.
Certainly,
Thanks.
sir. Thank you. So that quickly reminds me of my first lessons in M&A when I was just reviewing my first term sheet, which mentioned the enterprise value of the company so and so on a cash-free, debt-free basis, subject to normalized working capital. Sounds simple, right? So I just asked my manager at that point of time that why do you write so much of stuff, right? I think you first arrive at the enterprise value, just adjust the net debt or net cash and pay off the money. Why do you really need to mention a normalized working capital? So he explained it to me. What happens as a seller, I am always motivated to increase the value. So to show a higher cash on the balance sheet, what I would do, I would convert my receivables faster. I'll reduce my inventories, right? And show a higher cash so that I can increase the valuation. Now, if that is happening, it is actually hitting the buyer indirectly because he's actually inheriting a lower working capital when they are acquiring the company. So that's where I realized that how do you term sheet, how do you make the transaction documents, each and every wording, each and every facet is absolutely important, and that's where the diligence guys come into picture, validate what is a normalized level of working capital. Historically, what you have been maintaining, and just for this transaction, is it something which is suddenly coming off as a one-off or a surprise, which we must always be taking care of. So maybe with this, I have one specific question for Amirsh sir. I think you did highlight on some of the tax risks, but if you can give us some example wherein some high risk tax DD item actually impacted the entire structure of the transaction, and you have to actually change the course of a deal altogether.
So that happens quite normally in an M&A, I would put it this way. I think so once you start, this is the first thing is that, when we look at diligences, and if there are multiple companies from a tax perspective, we need to do diligence on a tax side on everything. While from a financial perspective, one may look at only the consolidated, financials and then do the diligence. So I think that's the first important point. And in one case, what happened was that we realized that, suddenly there was the revenue was split between two group companies, and we were only doing diligence on one. And then we had to get both of them into the transaction to be able to actually do the deal. So, but the seller side then said, no, I will do a restructuring and then we will do the transaction. So in a way, the transaction has got postponed. So you get into those type of very interesting situations, and at many times, you decide whether the transaction is important. So for example, let's say when you do a diligence, and there is enough of carry forward losses, and it's a services company, right? Now you may want to take advantage of that, and then you will think of a merger, and therefore you start doing, and then suddenly you realize, no, on merger you will not be able to get the carry forward of losses, so you think of a demerger. So again, the entire transaction structure gets revisited. Your diligence gets revisited, because when you are taking a part of the company, right, from past tax issues, you are only limited to the past 2 years. But when you are taking the entire company through, an acquisition or a merger, you are then, the entire company is with you, so entire past history is with you. So again, each structure, each element will have its own nuance. And many times, you move away from acquiring the company to only acquiring the business, because maybe there is a past litigation history which is, very, very there. It's probably an issue which you don't want to deal with. Maybe the seller is able to deal it in the best possible way, or the target company is able to deal it in the best possible way. And this we have seen more often, when an MNC is acquiring, because, at times their way of dealing with, tax matters is very different than maybe, some Indian styled groups dealing of tax matters. And I think we need to therefore realize who's our client. And I think the other thing is, the diligence doesn't start, once the term sheet is done. I think the Vodafone case and many other cases are because, things were outside of the diligence or the M&A documentation. We've seen situations where we generally write in the term sheet that, we will come to a structure which is tax efficient. Now in today's GAR world, that itself is going to be your first attack once you do the deal. So we've started, telling clients that, please let us have one quick look. We just want to avoid anything that will give a touch point to the tax office at a later date. In fact, I have seen situations, where they have come back to say, what was there in the diligence? We want to go after the target company to understand what were the issues in the diligence. Now that's even more dangerous, right? Because despite you may having the findings, right? You may be using your submissions and you may be, trying to, protect whatever calls you have taken from a target company perspective. So how do you insulate yourself, creates the entire issue. We had a very interesting situation, and I think it's more about the insulation that you need to create if you are getting into the company. We had a situation where, the subsidiaries who were profit making were giving loans to either the parent or the sister company. And the value was extremely high, and under 222E, if I were to take at that time the 35% tax rate, the amount itself was almost 1,000 crores of tax if somebody were to look into it. Now, it's always a fact-related issue on a 222E. Now, in a diligence, we are not going to do an audit. So you're not going to do a scrutiny. Your time limit is 2 weeks, 3 weeks, maximum 4 weeks. I have never seen a diligence go beyond 4 weeks. If it happens beyond 4 weeks, means I am sure that the transaction is not going to happen. I'm pretty sure on that. But I'm saying it is a 1,000 crore issue. Now, obviously, the seller had never got any tax notice on this, or the target had never got any tax notice on it. But we as a buyer always felt so heavily about it, right? And when you represent a buyer, you have a mindset of everything will go wrong. When you represent a seller, you are trying to find out the favorable judicial precedents and trying to protect yourself, right? And you fight hard. So it's always, again, which side of the coin you are on. I mean, is the way I look at all of these situations. And it's also important that we tell our clients, let's say if this is a seller situation, I was advising the seller, I would say, boss, this is a risk that if I was on the other side, I will bring in. Let's look at the mitigation today before even we start the process. So I think that's also equally important, that you make them aware about what somebody else is going to pick up on you. Because then a transaction will happen. Otherwise, it can get into this rigmarole about constant negotiation and renegotiation. So just coming back to that 1,000 crore issue, we ultimately dealt with in a very different way in the deal, and the deal had to be modified to that extent. And it became complicated, obviously. But what we did is, the acquirer was a non-resident. We got them to get an instrument which we call the optionally convertible, redeemable preference shares, or a compulsorily convertible preference shares. That was an infra company, so we were able to do the other one through the FVCI route. And we were able to therefore determine, depending on, again, statute of limitations. So as 1 year dropped, the value of that 1,000 crore came down. So I got redemption of the preference shares because then my value had, number of shares or percentage of shares that I had to have in the company was lower. Then next year came, again, the value, increased for the company, and therefore the seller had to be in a better position. And I had to get lesser number of shares. So we had to do a year by year thing, that now the statute of limitation is gone, and it became really complicated. So I mean, you can get into several such different situations, but these are some of those which, remain with you because you lived it, is the way I look at it. So, but I think it's important that we consider both sides' perspective, because then you can advise your clients in the best possible manner. And sometimes you need to prepare them, and sometimes you need to, just go whole hog and say, this is the only way it can be done.
Going back to Ketan, sir, I think if you can throw some insights around a certain specific sectoral considerations that you may have come across in M&A transactions. Sorry.
I think he was asking me, what are the sectoral considerations in M&A? So for lack of time and just to move forward,
Yes.
am I right, Chinmay?
Yes, yes, please.
So, there, let me just focus more on the commercial and financial, less on the tax, because tax would, in some sense, be sector agnostic, in some sense. So let me take 5-6 examples, Let's say IT companies, information technology companies, and I'm on the board of one. So typically many IT companies do what they call, bolt-on acquisitions. That means, let's say I am a company with 10,000 crore of revenue. I'm acquiring a company with very special skill sets in, say, artificial intelligence related IT, okay? Because I don't have that skill, okay? I'm more a general IT company. Now, this kind of special bolt-on acquisition, typically, and many of these, by the way, are cross-border acquisitions. So, we've done, in the company in which I am, we've done some 8-9 of them over the last 10 years. They're small companies, but very specialized skill, based in Seattle, relation with Microsoft, understands AI, number of people 75, that kind of company. So there, the sectoral consideration, Chinmay, would be, you look at the team, the motivation of the team, how do you motivate them, amount of holdback, earn out, do they genuinely have the skills that they talk? Are they talking about a technology that is likely to become obsolete, in which case I'm not sure what I'm acquiring in the first place, etc., etc. So that's one category, The second, let's say EPC companies, So one of the things in EPC companies is, is this EPC company dealing more with the government or less with the government? Because if you deal with the government, you have to factor in the additional risk of the way of dealing on government contracts, including existing contracts. Escalation claims may not come through, you will not get the money, the mindset of the group or the company may be more of dealing with government contracts, whereas you may be acquiring them for skills to be used for private companies or private sector. So what are the considerations around that? In terms of existing contracts, what is the stage of completion? What could happen? So again, this would be, Amirsh Shah, financial due diligence. What could be the liability that could arise? Correct, Chetan? In relation, because, cost to completion, where are we on that? When will the contract, building a tunnel, at what stage is the tunnel? What if happens if you don't get some right of way? All sorts of things like that in an EPC kind of company. Let's say a financial services sector. Now remember, financial services is a very broad term. Are we talking of a bank? Are we talking of an NBFC? Are we talking of an insurance company? Are we talking of a housing finance company? So some issues will be again, granular at the subsector level, as I call it. But at a broad level, in financial service, the 2 or 3 big daddy points. So in NBFC, for example, or a bank, for example, NPA could be a big point, solvency could be a big point, The other issue could be IT systems integration. It's a huge issue. In HDFC and HDFC Bank, which was in some sense a semi-group merger stroke acquisition, but that IT integration is a nightmare. The number of people I know who have worked on that IT integration, you cannot even imagine. So something going wrong in that IT system for even 1 minute will show up in the CNBC ticker for the next 6 weeks. Okay, so that IT integration, they seem to agree with me. So in financial service, as I said, depending on the type, an NPA could be an issue, and IT integration. The third issue in financial services, a huge issue, is regulatory overhang. For example, RBI, in an NBFC company, an RBI inspection is there, big red flag. In an insurance company, if IRDA has given some, and out of 50 observations, there may be 5 that may be material. But if the 5 are material, the implication of those 5, because regulatory overhang in the case of a highly regulated sector like financial services is a bomb. I can tell you. From practical experience, I have seen NBFC company, getting so scared of RBI. Arre baba, RBI ka notice aaya, ye, wo, so that's a big consideration in that kind of company. Come to a different kind of sector, chemicals. Again, I was not aware of this, and I then became aware and I realized how serious it is. Safety. Some damn chemical leaks and there is a blow up. Not only is your factory gone, you will be going around in circles in that issue for 20 years. So the safety issues in a chemical company, and particularly if you're dealing with hazardous chemical. So, Chetan, you were speaking of different kinds of due diligence. So that safety kind of I don't know what you call it in your technical term, environmental due diligence, is a huge challenge. Okay, huge issue. That's another example. One can of course go on with, examples like this. So say in FMCG, I'll give a couple of more examples. Distribution network, the robustness of the distribution network. I remember many years back, I was the relationship partner on a major US multinational. And the global CFO was there, and we were going in a car at Powai. And he saw his product at the Panwala shop. So he says, Ketan, how did my product land up at the Panwala shop? I had no answer to that. Because in his mind, it could land up in Walmart. It could land up in Walgreens. But what is this concept of the Panwala shop, and what the hell is the amount of money he's making, and what is his incentive to do? I said, I have no answer. I'm not a distribution expert. So I said his name was Stephen. So I said, Stephen, I'm not sure, but I'm sure he's making some margin. He looked at me, he was not convinced, but we let that conversation pass. Now, this kind of distribution network in India, it is mind-blowing to create it, Hindustan Lever, 6 million outlets, It's unthinkable how you can build this distribution network. So when you acquire an FMCG company, the true robustness of this distribution network is one issue. The brand, is the brand sitting in the company? Is there a claim against the brand? Is another sectoral issue, and so on and so forth. I'll just give one more point, which is, Chinmay, not a sectoral point, but I've learned it over the years. So in a cross-border acquisition, again, not sectoral, it could for any sector. One of the biggest issues, and we are looking at a company in Israel currently, and of course with the Israel, Hamas, Lebanon, and these guys throwing rockets at one another, we are terrified, except that the investment bankers with the seller are saying that the company is headquartered in Israel, but really the facilities are at X, Y, Z. So we are looking at that. And the issue in a cross-border acquisition is cultural mindset, cultural fit. So in one case, a small acquisition was done in Denmark, and the chairman was very frustrated. So he said, I call up this guy at 4 o'clock on a Friday. He's not willing to talk. I want to go skiing. I want to go this. This guy said, what are you talking about? So he says, call the guy on a Friday after 2 o'clock. Done. I mean, this kind of culture. Now, this is not a sectoral issue. But, you have to be cognizant that people in Europe, they may be very productive when they work. You tell the guy to work more than 40 hours, it's like committing a crime in most cases. So it's, again, not a sectoral issue, but I thought it would be interesting, and therefore I mentioned it.
No, certainly, sir. Thank you. Maybe I'll leave that.
Maybe just to add, I think, Ketan, when you talked about culture, the biggest merger failure happened 25 years back, which is the Time Warner's AOL, where they could not meet cultures, and ultimately, AOL had to take a $99 billion hit, and then it collapsed. Because, in those times to take a $99 billion hit, is something out of this thing. So, I think very important element,
Yeah. And also just to, I don't have the statistics with me, I'm not fully updated, but large M&A transaction which happens, most of them are not successful also. Many of them basically are failures also. So as you mentioned, many times the deal is also done because of emotions and other things, and then you actually end up a failure because of so many reasons, including the culture issue, the integration issues, the other issues which comes into that.
So certainly very imperative. I think.
So Chinmay, sorry, just to add,
yes,
just
please.
on this, because we are on the sectoral part,
Yes.
just from a tax perspective, if you look at different sectors, I think, there will be very industry-driven issues that you will come across, and I think that becomes your starting point, when we look at tax diligences in particular. So if you look at a startup, the first thing is, this entire issue about whether you can claim the exemption, because you are DPIT registered or not registered, for getting shares issued at a value higher, premium being higher. So, you start from there. Then, you look at what could be the issues in the past when they've raised shares, on 68 additions, right? And that becomes sort of, it's a startup driven thing. It's generally more prevalent there. So, you know, you need to orient yourself, you know, when you're doing the diligence with, you know, those things in mind, and, you know, look out for those things, you know, as you go through the diligence. When you look at, you know, TMT, generally, there are cases of not withholding taxes on software payments, right? So that, again, because it's an industry-driven, you know, sort of a issue. So one has to, or equalization, you know, levy provisions, whether they have been complied with or not, you know, when you look at software, this thing. In healthcare, you know, you'll generally look at no withholding of taxes on benefits in kind. Now, you know, so again, every industry will have some nuance, and I would, you know, urge everybody, just figure out what are the industry issues depending on the target, you know, in which industry it is, and then it becomes easier. And whoever is aware about them, there's no harm in talking on a no-name basis, you know, to figure out anything more, right? So that is very, very important, you know, as you look at the sectors.
Certainly, I think the softer aspects of the deal, you know, we often tend to overlook. But I think Ashwath Damodaran, I'm not sure how many of you have read or heard him. He's called the valuation guru, and whenever he sees any M&A transaction happening and anywhere, he just simply writes off that company. So he's absolutely against M&A transaction. Like sir rightly pointed out, you would see more failures than success in M&A transaction, and that's precisely the reason why due diligence imperativeness is absolutely very critical and necessary. So maybe next question to you, Chetan sir, is about, I think you did touch upon certain aspects where as a due diligence advisor, we need to take a contrary view vis-a-vis what is being shown in the financial statements, the auditor's report, etc. So if you can just throw some light around that.
And just on the lighter side, if the transaction is not successful, diligence guy always made the scapegoat. इसने diligence बराबर नहीं किया रहेगा. I think on your question on audit, look, I don't think we are not doing any audit, so we never try to take a contrary view that way vis-a-vis the auditors. In fact, as I told you, our starting point is the audited financial statements. If we don't have audited financial statements, then we tell them that at least give us the financial statements in the same format as you would have given the audited financial statements. And of course, we will also do a deep dive, start from the trial balance and try to understand how the numbers are coming. But you know, the entire process is deal driven. While the auditors, they are giving true and fair view based on Companies Act and all those things. But our entire diligence focus is deal driven. And unlike audit, which is mandatory, diligence per se is not mandatory. But it has been a practice for through all the years that for any transaction, the diligence has to be done. So that way, you know, there is nothing called contradictory kind of a stuff. But of course, you need to understand, and when you do a deep dive, from a deal perspective, you might come out with so many adjustments, which in the normal course, the auditor would not have taken care of. For example, if you are, say, dependent on a customer from where the sales, 30% sales are coming from one customer. So it's definitely, it's a diligence issue, but as an auditor, he would not be concerned unless that 30% customer is becoming bankrupt, for example. But when I'm doing a diligence for a buyer, then definitely I will point out to them that there is huge dependence on one customer. And if it's a strategic buyer, then he would be more concerned whether in future he is going to become my competitor, not competitor, whether he will continue after the transaction, whether I need to take his permission for this transaction, XYZ kind of. So it goes on. Something, say for example, we always come across lease accounting. Now I think in India, normally all the lease thing is shown as interest or finance. But as we mentioned, normally you do an EBITDA adjustments in any transaction. So you definitely would do a readjustment to your EBITDA. So we are not going against the auditors, but the deal demands that, you know, these are all EBITDA items, operational item, and you need to do an adjustment above EBITDA. Similarly, a classic example can be, say, security deposits from various dealers. In cement is very much apparent. You normally take a lot of security deposit. In a lot of FMCG transactions, that is very much prominent. And some are interest bearing, some are non-interest bearing. So most of the time, I think if you talk about old dealers, it will be like a quasi equity. It's just going on. You are doing nothing. But of course, as the thing progresses, you start paying interest. So how you will treat that item? So one really need to understand whether it's really operational or not operational. If it is operational, then definitely interest will become an EBITDA item, not as interest cost kind of a stuff. But then I also cannot do a debt-like adjustment in that, because I cannot consider it as cost equity or debt. If I take interest as debt, then of course it has to be below EBITDA. So on a case-to-case basis, the things, one of my example which I could recollect is LC-backed creditors. And some business, I mean, in one of the transaction, almost 80% of the business was done through LC-backed. So all the raw materials they were purchasing, they were all LC-backed. And it's a classic diligence adjustment. All LC-backed creditors are nothing but debt-like, in the sense that in future it's going to become debt, and you will have to pay it to them. And when we told the buyer, and informally we were discussing the issues with the seller, they said if this thing is going to happen, it's a deal breaker. If you take everything as debt-like, then there is no deal, because the formula is then enterprise value minus debt and then debt-like. So if you take entire, and these are largely my working capital requirement, so I cannot do away with it. And that is something on a P2P basis they sat together and they came out with some formula, and they told, okay, we'll take something as debt-like, something as working capital. So to answer your question is, there is nothing called, whatever the audited numbers are given, and that is the starting point. But everything is basically deal-driven, deal-specific. And it becomes more challenging when you are representing a vendor, then the dynamics changes, because the interest of the seller is totally different. And when you are representing a buyer, the dynamics changes. So one really have to go on a case-to-case basis. And I would just tell you, I've done so many diligence for last 28, 30 years. Though the issues may be standard, but I haven't come across any one issue which are common in both the things. So every time you come across some different issues in different format or different form. So it's nothing like copy and paste kind of a stuff. You actually come across with a different kind of issues.
Certainly, sir. I think I have a bad day with mic.
Yeah, you can take this one.
Hello.
Take this one. Yeah.
Yeah, so a lot of times we also get asked this question that, what are you going to really look into due diligence? My accounts are already audited. The auditor is one of the big 5, big 10 firms, and what are you really going to look at as a part of due diligence? So I think that's where the rightly touched upon. So see, the audit is, of course, audit of a general purpose financial statement, whereas due diligence is a very special purpose sort of an assignment. And that is essentially where the scope definition of due diligence really drives value in a transaction. So just to take this thought forward, Amirsh Shah, some similar thoughts that you may have also come across when you talk about tax adjustments vis-a-vis tax audit, and similar questions you would have also faced from clientele.
Yeah, absolutely. I think, again, whether you look at tax audit or statutory audit, it's more of scrutiny and, what you need to give. So it's a purpose fit thing is the way I would look at it. A tax audit is also a purpose fit thing to be able for you to be able to file your tax return, right? Whereas a diligence is more an evaluation. You are trying to understand the issues on hand. You are trying to put them into a perspective that tomorrow, if these issues have to be carried forward, would there be a challenge from the tax office or not a challenge? So that's one part of it. The second, you will also want to see whether the tax balances as they are appearing in the financial statements, right? Whether the DTA or the DTL, are appropriately stated compared to what is appearing on the income tax portal, right? And therefore, is there a gap? If there is a gap, what is the rationale for the gap? So again, it's more of an evaluation rather than saying what is stated in the financial statements or the tax audit report is something wrong, right? It's again a judgmental call, right? And again, if you are representing a buyer, you will be conservative, right? But if you are representing the seller and doing a vendor diligence, again, you will have a different position. You will put down the facts and then provide whatever are the favorable things. So that differentiator will always remain, right? And there are certain things which are not there in the tax audit report, you will still look at it. So for example, if there is any past restructuring that the company has done, not necessarily everything will come in the tax audit report. But does that create any tax challenges which can come up? Or are there notices issued by the tax office relating thereto? And how have they been dealt with? And do you get enough and more comfort on it or you are going to have a problem area as you take over the company. And then this will lead into which basket you want to put them into. Because, ultimately, there is going to be a deal. Let's say if commercially everything, what Ketan said is agreeable. I mean, as a tax professional, I cannot stop a deal. Unless it is going to be just too big a number for them to swallow. So what is it that from a practical perspective? So is it going to be a value adjustment at the end of it? Is it going to be an indemnity? And again, indemnities are of two types, as you all know. It's a general indemnity, but it gets blocked by a disclosure letter, or it's a specific indemnity. Whether it is a high risk item and therefore you want to hold back an amount and then pay it, as the amount goes, or you need to do some other structuring. So each element, while obviously we will look at the tax audit report. So it's not that we won't look at a tax audit report when we are doing a tax diligence along with the financial statement. But the objective behind the diligence is totally different than, what is there for. Tax audit is more of disclosure, is the way I would put it, so that the tax office can look at it along with, your financial statements, your tax return, and then come to a conclusion in terms of the tax assessments. Here we are going to take a call looking at not only that, but what is there beyond. And that's the evaluation phase that, I always talk about. And again, everything has to be customized, right? You may be doing tax audit for 20 years. I'm not going to go and look at 20 years. Generally, it's a 2-year plus the broken period, right? So it's only that last few years. But obviously, I look at all the past litigations. I will look at, all the restructurings that you have done, at least which is, within the statute of limitation. Because issues will come up there if there is, a documentation which is not done in the right. And a simple example is, if they have issued shares in the past and have not taken a valuation report, could there be a 56(2)(7)(b) issue? Share premium being higher. I mean, as simple as that, right? And in many cases, we are feeling that companies have not done the right thing there. So those become, today in the diligence, those are becoming more important issues. Now, in the tax audit report, you'll always feel that, it's been done in the right way, right? So I think there will be that differentiator that will come into play. And you'll have to look at the company, look at the issues, and then, bring them out.
I will just
Yes, sir, your thoughts.
You want to go in first?
Yeah,
No, just couple of supplements to what Chetan said and to what Amirsh said. To what Chetan said, again, are we going to differ from the statutory auditor or not? 2 examples where such a thing can arise, One is revenue recognition. You see, of course, Byju's was an extreme example. But in that extreme example, see what happened. The entire fundamental of the company's accounting was challenged. So, as an acquirer, suppose I were to acquire, I am acquiring a company and looking at a revenue which revenue in the context of what later turned out was perhaps not the right revenue in the first place. So what are we talking about here, The second is contingent liability versus provision, So some people may say this is a contingent liability, but I may say no, it is more likely to arise than not, and that can change the entire face of the balance sheet. So those are 2 points on what. On Amirsh, what you said rightly, my blood boils when I think of 56(2)(7)(b), you are aware of this, but it's such an absurd, ridiculous section, but it is there. There is, of course, a talk of this so-called angel tax, which, by the way, is nothing to do with angels. It applies to all private companies. So there's a talk of doing away with it. And I always say that the most logical way to deal with the stupidity is to accept it and do away with it. But as Amirsh said, if it is there, you must look at it. 56(2)(10)(b), you mentioned about restructuring. Suppose I am a company which is being acquired and I have been the resulting company. There is another absurd provision, 56(2)(10)(b), that if it is held to be in non-tax neutral demerger, I could be liable to that so-called 56(2)(10)(b), which to my mind is a gift tax. Third is a potential GAR exposure. And the fourth one, which very often we miss, I have always felt that TDS is, to put it as an onerous provision, is to put it mildly. First of all, I'm doing the government job. Now, if I have not deducted TDS, prosecution, penalty, and disallowance under Section 40. Now, what kind of exposure this is? Now, these are the kind of issues that one will have to look at. And as Amirsh said, the seller may come out with all these favorable case laws. As a buyer, I may have to evaluate and say, is this some chance I want to take? Is this really there may be a negative case, but the tax department has been absurd. I don't think it'll happen, etc., etc. So, I mean, these are the kind of issues that would emerge.
And just
Yeah.
one more point is, what is the alignment of the tax policies between what the seller is doing and what the acquirer is doing, especially in a transfer pricing situation. And that becomes very important. That will never be there in the tax audit report because they are only looking at, one entity. We have to look at it, from both perspectives. And, that itself can throw up some challenges.
Yeah, just to supplement Ketan on the accounting policy. So we were doing a transaction, this was about 10-12 years back, where the company was doing lease accounting, but not as per Indian GAAP, but they were doing as per actually IFRS Ind AS at that point of time. And the entire deal was as per Indian GAAP. And we had to actually say, if you are actually following Indian GAAP, then there will be a lot of recasting of your financial statements, because strictly speaking, you are following IFRS, but your entire deal is as per Indian GAAP. So sometimes these things also happen, and your entire deal dynamics changes. Just coming to the tax audit report, as a part of FDD also, we always tell our team to look at the tax audit report, because it's not always tax people's job to look at the tax audit report, because there are so many details on inventory, the quantitative reconciliation, wastages, if they are basically giving all those details, then related party transactions, other transactions. So you get so much of information in the tax audit reports. It's a very important document from a financial diligence perspective also.
I think next question again to the all of our panelists. I think what sort of skills do you see should small and mid-sized firms possess to venture into and grow into due diligence as a space, which historically has always been led by the larger firms of the world? So with Ketan sir, we can start with you first.
Yeah, so I mean, Chinmay, I will broad base this as not just due diligence, but the larger M&A structuring space, because the mindset requires different. So 2 or 3 points I want to make there, First, you will have to have the mindset to get into it. And in that mindset, you have to realize that in an M&A transaction, which includes due diligence, which includes tax due diligence, which includes M&A structuring, I think you require the mindset, which to my mind, we call it in our firm the CRT formula, which is the intermesh of commercial regulations and tax. And in regulation, I would even put in days, So you have to have that integrated picture as opposed to a siloed picture. And the commercial imperatives and commercial understanding, to my mind, is most critical. Now, in a mid-size and small-size firm, that mindset to get that right team of people. I was just telling you, Chinmay, that for our small firm, recruiting that one person with that CRT mindset becomes a nightmare. To getting the people is the key, because remember, in a small and mid-size or for that matter, any service organization, what are our assets? People. Our assets go up and down in the lift every day. So if the team is not right, you will not be. That is point 1. Point 2, focus. I always used to give this example that, the age of multi-cuisine restaurants is gone. Earlier my daughter used to say, I used to tell my father, let's go to a restaurant. My daughter is now, of course, 38, but even when she was 15, he used to tell me, can we go to a Lebanese restaurant? Can we go to a Chinese restaurant? Can we go to a Mexican restaurant? So it is a specialization thing. The age of multi-cuisine restaurant is dead. So if you have a firm which is doing 5-6 things, no problem. But that team, if it is not dedicated, it will always be a problem. So I think there is that, as I said, mindset, focus, integrated skills. This is one dimension. There is another dimension which I think, Chinmay, is a very unorthodox part, but my 2 ex-colleagues from PwC will know. In my PwC days, I always used to say this, that there are 2 elements to a professional services situation and why a client will retain you. And I used to call it content and connect. So the content part, to some extent we spoke, mindset, skills, talent. There has to be that content and knowledge and updation, but also the connect. Now, this is not the kind of answer you were expecting, but I thought it would be useful to share it with the people here. We as a community of CAs are not well networked within the business community. So if we have the content, but we don't have the connect, it's difficult. You know, as if I might give a crude example, it's like winking at a girl in the dark. You know what you're doing, but she doesn't. Right? So you have to make sure that she can see what you're doing. I mean, unless you feel that she's going to slap you. Okay? So the point is that the content, the connect part is also important. So I'm not saying that you go out and start marketing. That's not the point. You have to be networked within the community. So I think these are the two things, but of course content will normally take more weightage, because if you just have the connect but no content, the guy will come to you once, he'll never come to you again. The content is there, and these are the kind of skills, but I think focus and then building that team, retaining their talent. By the way, one more point. Again, I know, Chinmay, this is an unusual answer. You know what happens is, you have to then, if you are running, particularly if you are running a firm with different segments, one of the challenges you will face is that for these kind of people, the remuneration will be different from the others, unless they have their own specialization. I mean, you know, so you can't compare the remuneration of a 5-year or 7-year professional with structuring or due diligence skill with one who is doing routine compliance and filing returns. You cannot compare that. You cannot compare that. So if they go on comparing, then you have to first make that distinction and say, look, the skills are different. It's like almost running a different business. So I would say this kind of.
So Chinmay, I think just to add to the mindset issue, I think we need to overcome our fear of the unknown. I think it's the fear of the unknown which is very large. You know, and I said this because when I did my first diligence financial 32 years back, I did almost like an audit. But, you know, you will grapple with new situations, you will grapple with different things. But if you are going to be, you know, just not wanting to move ahead, and that's how you learn. It's not going to happen overnight. It is going to be a learning journey. And you know, that's where I see that difference. Now we see a lot of mid-sized firms who are getting into this much, much more than what we used to see 10 years back. And I think that's the encouraging sign. Because the country needs many more professionals in the M&A field for us to achieve, you know, the targets that we are setting for ourselves in terms of the GDPs and all of that. Because without that, we are not going to be able to achieve. Because if you have a defined set of people only, I don't think we will move very fast on this. And I think that's very important. So to overcome that fear of the unknown, right? It's like this, you know, when we all gave our CA final exam, we never knew what the result is going to be. When we were preparing for the CA final exam, we don't know what we were entering into, but we still, you know, overcame that. But I think over a period of time, we tend to become very, you know, I would say regimented. I think that needs to be, you know, overcome, because unless we do that, you know, that mindset is not going to change. You know, I mean, some people, you know, have that benefit because seniors in their firm, you know, have been doing such type of work, so they benefit from them. And you know, I count myself one of the most luckiest in that perspective, and Ketan, you know the reason. So it's not that, you know, everybody will be in similar forms, right? But it's something like, so today's seminar, now you would have got from yesterday and today 20 points that you can mull over, right? Keep them with you, see where you can apply them. It's only when you apply them is where the practical aspects will come into play. And the more you do them practically, the more easier for you to overcome your fear. I mean, you know, it's like this, you know, if something is easy, I want to tick off first and close it. But no, if something is not easy, I need to give that the same attention. I can't keep on pushing it back. And that's, I think, the difference, you know, on this.
Just to, you know, further add on, you have to put yourself in the shoes of a buyer. I think then only you will understand what kind of issues you are basically doing, if you as an investor would be investing in that company or not. If you do the diligence with that mindset, then the other things definitely will take care of it. And we need to understand there is a deal transaction which is happening, and there is hardcore cash which is going to be exchanged between the two parties. So one need to be very thorough and, you know, understand these aspects quite clearly. Unlike the routine work which we are doing, this is totally in a different context altogether. And maybe this may not be directly in that context, but you need to have a good report writing skills also, which is the key. So it's like whatever hard work you do, it should get percolated in your report. It's like a movie. Somebody spends 1 year, 2 years to make a movie, but the end of the day, it's that 1 hour, 2 hour presentation which will, decide the fate of the movie. So for us, it's the report which will decide the fate. And God forbid something goes wrong, the report is going to be looked at it only after 4 years, 5 years. And this is what I always tell my team, that I am working on the report not for tomorrow, because everybody is in a mood to close the deal. So they just want, what are the issues, let me understand this, blah, blah, blah kind of thing. But if something goes wrong, then the same guy is going to catch us after 2 years, 3 years, 4 years, that aapka report mein ye nahi tha, this was not that, this was not that. And it's a team effort. So I can't say that, okay, I'll roll up my sleeves, I will go and do the diligence. You need to have a good amount of team effort also. So it's not a one-man job kind of a thing. You require a good team to take care of all those things. So these are also softer issues one needs to take care of it.
We are at the end of the session, so I would just want to request, if at all there are any questions specifically for the panelists. Yes, please.
So what are the precautions you take for that due diligence? Suppose the deal is going to happen, and what are the points that you top 3-4 points?
See, GAR is a very wide subject, frankly, right? What transaction will lead to GAR is going to be very judgmental, right? You would just want to examine that if somebody has done a transaction in a certain way, if you were the tax officer, if you are, advising an acquirer, if you were the tax officer, how could you have attacked it? That's the first parameter that you need to keep in mind. Then you come and, get your advisor hat on to say that how will I try and, protect this, attack that I am under. If you come to a, sort of a reasonable this thing, right, that you cannot protect, then you will change the transaction structure to say that you are out of that issue. If you feel comfortable or there is a value adjustment already agreed by the other side, then you go ahead with the transaction structure in this. But there is no, because see, GAR is ultimately linked to, whether it is a commercial thing that has been done or whether it is an artificial thing. So it's going to be difficult to come to a situation, which is there. And we're still just entering into a GAR situation. And, tax office is known to take different positions on GAR for the same issue. Or same principle also. So it's a very tricky one. I think the only lens that you can apply is that does this justify a commercial aspect or not? If you are able to get to that answer, then obviously you will advise your clients accordingly.
Yeah, just one small absolutely right. I was just going to say the key issue is commercial justifiability. I just want to add one nuance to that. It's critical to understand that you don't need to pay the maximum tax, right? So the point is, if it is commercially justifiable, the fact that I chose a route to get to that commercially justifiable transaction in an X manner, which makes me pay less tax as opposed to a Y manner, which makes me pay more tax, is still commercially justifiable. It's like saying I came from wherever I came from the coastal road, because it is less traffic, but the commercial reason or the whatever the reason, the justifiable reason, I wanted to reach ICAI tower. So if that commercially justifiable destination can be sort of manifested, the fact that I came by coastal road and decided not to take Pedder road where there was more traffic, that should not be a GAR trigger. That's the point I'm trying to make. I think the heart is commercial justifiable. The second point, which is a technical nuance to this, is, if you look at 95.7 or 95.4 or whatever that section is, it says to obtain a benefit. Now, to avoid a disbenefit is not obtaining a benefit. That's the point I want to make.
Yeah, and I think the other important element, from an overall perspective, in this commercial, this thing is that ultimately, right, it's a call that you'll have to take. It's a judgment call, because it's not, black and white, unless somebody's done something which is totally, wrong. So it's going to be a difficult ask. And at times what we do is we also go to counsels to see whether, what we are saying in terms of the defense of, a situation which could be GAR-like, and what will be the situation. So we also do that. So it depends on who is giving the indemnity, obviously, right? If there is an individual seller, we will never rely on an indemnity, frankly, from a transaction perspective, because we don't know where that individual will be when it comes to invoking. If it is a corporate-driven indemnity, we'll again see who the corporate is. And that's why, you either do a value adjustment or you keep an escrow, or nowadays, you also take an insurance. And insurance on target operation from a tax perspective is also available as a product. So you will decide depending on the circumstances which is where you will fit the bill to be able to be, getting the benefit of whatever you have done, whether it is a escrow or whether it is, an indemnity, because it's easier said than done, as you rightly said. But therefore, you need to look at what is the variance. Again, the commercial part will come into play to decide which of the. It again depends on who is there, right? So if let's see if there was let's look at, the Tata Docomo case, right? The Tatas, after going to court, did pay. It is the intention issue. It is not the timing issue. If I don't want to pay, I will create 101 hurdles. But if the intention is clear, right, it can happen within a reasonable time frame. And it again depends on what the issue is and regulations that may affect that indemnity. So I think it's a factor of some of those things. But I think the intention of the indemnity payer needs to be clear. If that is not clear, it aren't happening. Because in India, we know how the legal system is. So it happened. Whatever it is, it happened. That is the point. So intention was very clear. Whoever overruled, not overruled, but ultimately the intention was clear to make it happen. They fought in the courts and then they made it happen. They went against RBI and they made it happen.
Thank you so much. On behalf of WIRC and all the attendees, I propose a vote of thanks to CA Chetan Khandahadia, CA Ketan Dalal, CA Amirsh Shah, and Moderator CA Chinmay Naik. You all have successfully thrown light on your expert thoughts and practical aspects on various facets of due diligence of M&A transactions. Thank you so much. And really a loud applause to all of them. Thank you. We will immediately commence with the next panel, so don't go away. Thank you.